Prime Minister has had a busy few weeks reforming policies such as net zero, scrapping HS2 or pushing through North Sea gas and oil licences. But it seems there's even more method to these sensible measures than some may have thought. What is clear about these policies is that there are very few costs involved. Indeed, scrapping the northern leg of HS2 saves us $32 billion and, considering previous overruns, potentially much more. Pushing through North Sea gas and oil licences will raise billions for the Treasury, especially considering the 75% effective tax rate on domestic energy production. And the reforms to net zero policy will let you keep more of your own money. But it seems these aren't just good policies because they're cutting waste and being more frugal with your taxpayer money. They're good policies because we could be facing a financial shift across Western economies. The cost of government borrowing has been rocketing. The return on 30-year UK gilts has just reached a 20-year high. And this has real consequences on capital values. If I give you an example, if you bought the 2073 index-linked gilt when it was issued, it would have cost you £330. It's now worth £62. That's a fall of 80%. So if you need the cash now, if you can't wait until 2073, you've had a huge capital loss. And we're seeing similar things happening in other Western economies, such as the US and Germany. And what this means is that markets are cracking down on government borrowing. They're saying that they don't have confidence in these economies to pay back their debts, or particularly in real terms, because they're worried about inflation. And there is a good reason for this, because governments have been spending too freely. If you think that the two great costs of the taxpayer every year, the NHS at about $183 billion, and then welfare, $230 billion, next you might expect education or defence spending, but you'd be wrong. In the year to May, debt interest payments were £117 billion. That's the third highest bill after welfare and the NHS. It's more than £2 billion every week as a consequence of historic borrowing. If you think last year we borrowed £128 billion, we're effectively borrowing money to pay the interest on our historic borrowing. It begins to sound like a giant Ponzi scheme. And this is why the cost in borrowing is so important, because it's a signal that we can't afford to borrow more. In the past, in recent years, a combination of quantitative easing and low interest rates, and the two went hand in glove, have given governments across the globe nearly free money. But that's changing with this shift in gilt yields, global bond yields generally. So what does it mean? Well, basically, we will have to cut expenditure. And this is a problem because if the economy is slowing, the automatic stabilisers put up the cost of welfare, but we're going to find that we don't have the money for it. It begins to sound like a repeat of the late 1970s and early 1980s, and we may well need similarly tough reforms to recover from this.